Good morning, all. Good afternoon to our European friends. Geoff, please mute yourself. Another day in paradise. Market's putting in a pretty good day today so far. We've got a great room. No stranger to this room. Longtime friend, very astute observer of markets. Geoff Garbacz, Quantitative Partners. Markets. Everyone is hanging on to every zig and zag. The fact that markets haven't made a new low for a month, people are right back to, oh, so you're saying there's a chance. And as I always say in this room, I don't try to figure out the daily and the weekly zigs and zags. I leave it to others. Geoff has a much sharper view of things and is more tuned to the more short-term dimensions, the dynamics of the market. So I'm always looking to him for some direction, as is our good mutual friend Tom Thornton. And so I'm really curious to hear what Geoff has to say this morning. Just a few comments about recent action, or just fundamental comments. I guess I'm not going to talk so much about price action, but the retail sales number last week, adjusted for inflation, down. People are getting all amped up because they think things look all right, but it's inflation that's hyping the numbers, and consumers rolling over. There were some bad PC shipment numbers out as well. The bank numbers at the end of last week were a disaster. And someone might say, well, but the stocks didn't go down. Well, at least they didn't go down for a couple of days. We'll see. My focus continues to be on trying to get the intermediate to longer term direction right. With liquidity continuing to tighten and earnings rolling over. But keeping in mind that we're going to get, we will get it's a feature, not a bug, of bear markets, that you get counter trend rallies. And so, as we've discussed many times in this room, John Roque had that great study that he did. You go back to the 2002 bear market, where despite NASDAQ falling 80%, the market was down 47% of the days. There were 15 rallies over counter trend rallies over 10%, 10 counter trend rallies over 15%. I'm not smart enough to be able to catch all those. I know what I'm good at, and I know what I'm not good at. And my bigger picture always is, as I think Dennis Gartman used to say, in a bear market, you only can be short or flat. In a bull market, long or flat. So, if you're looking for someone to call the counter trend moves, the man in the house today, Mr. Garbacz or Mr. Thornton, they're really good at that. I'm not the guy who's going to make those calls. I know my place in life. So, with no further ado, I want to turn it over to the floor over to Geoff. If you want to know where the song selection came from for today's room, it was Geoff's idea. So, Geoff, over to you.
Hey, George, how are you? I love it. The more things change, the more they stay the same. That's kind of the year that we've been in. Although there is some potential for this month, with 9 days left, to get a subtle change or two taking place. I think, George, you had some really good stats, and so do I, on kind of where we are on a year-to-date basis now. And I'd love to start there and then talk about the month-to-month action, and then specifically what we're seeing in the work. So here comes what I think are some pretty amazing statistics. One thing I really like to do is track on a monthly basis how many stocks are up and how many stocks are down. And our universe is basically every stock that trades that's been trading for at least 6 months. And clearly we've had a dearth of IPOs this year, so we're not missing that much stuff that's traded for less than 6 months. Year to date, 16.12% of stocks are up through the end of June, beginning of July. You actually do every Friday, so it was July the 1st. At the end of May, it was 21.83%, so we lost another 6%. And it's been it ended last year at 55% of stocks up for the year. And the highest we got to was 34 at the end of the first quarter, at the end of March. So you can see we've almost had like a 50% drop since the end of March, from 34 down to 16, actually a little bit more than that. The next numbers are really interesting numbers. Just remember this number, 10x. So what is 10x? One thing I love to do is look at the attribution of performance. So how many stocks are up more than 50% and how many stocks are down more than 50%? So this is where 10x comes from. The number of stocks that are up more than 50% is 101 stocks. The number of stocks that are down more than 50% is 1,117. So take 101 times it by 10, and you've got, pretty close to your 1117 number. Then the next one I like to always look at is how many stocks are up more than 25% or down more than 25%. And that number up more than 25 is 251. And down more than 25 is 2,649. So again, 10x. What would be incredible is if I looked at the stocks that were up more than 10% or down more than 10% to get a 10x. I didn't get it. I got a 7x. So 511 stocks are up more than 10%, and 3,761 are down more than 10%. And year to date, the number of stocks that are up is 878. What was amazing was 2 weeks. 2 weeks ago when we had the good week, we only had 10 more stocks go up for the year. Like we went from 877 to 887 2 weeks ago, and then last week was a down week again. That kind of tells us where we are, and what I find amazing is that we haven't had the capitulation moment yet. I find it incredible that people keep saying this, no capitulation moment. And if we look at the first half of the year, this went down as the third worst first half of the year in the history of the stock market. So I don't get the idea that there's no capitulation kind of going on. And so the first glimmer of hope that exists is the statistics of looking at the other 5 periods where we lost as much or more than this period. What happened the second half of the year? In all cases, it ended up being a positive for the second half of the year. Doesn't mean it has to this time, but in those other instances, it did. And it's hard for the market to go down for just more than 6 months in a row at a really precipitous point without getting some type of rally. Having said that, things have been really awful since April. And that's part of what I'm going to get to about the more things change, the more they stay the same. The first kind of example of that. In the last 15 weeks, the S&P has been up how many weeks? George, you want to take a quick guess at that?
Yeah, just because you and I play tag every few weeks in this, I'm going to say it's either 2 or 3 out of 15, something like that.
It's 3.
3.
It's
Okay.
3.
Yep.
And
okay.
what's amazing is coming in today, 5 of the last 6 days have been down. I mean, last week we were down every day until Friday, and then yesterday was a down day. And so it's kind of like nothing has really changed. Although I will say this about the month of July so far. If I go back and look at the other months of the year, the month that it's kind of reminding me of right now is February. February, remember, January was a pretty bad month. It was, let's see exactly how much we did to the downside there. So we finished the low. Well, let's just do the low first. The low came on the 27th of January. We got down 9.24, and then we finished the month down 5.31. And February was kind of an okay month. We kind of hung in there until we didn't, which was the 16th of the month. We were down 74 basis points, and then from there, we went down very quickly. From the 16th to 23rd, we lost another 5.52%. So with 9 days left, this is reminding me very much of February. And then in March, we obviously had the one good rally of the year. The way I look at it right now, we've had 3 rallies this year. So just looking back in history so that we can then talk about what's going on right now. We had a nice couple-week rally in the middle of March. We went up about 11%. And then we had a bit of a rally the week into Memorial Day weekend. It was really driven by 3 days. And most of it came on that Friday into Memorial Day weekend. And then we had a little bit of it in the middle part of June and then again in the beginning part of July. But we've really gone nowhere. Since, let's call it let's look at this date. Since the 22nd of June, we've been in a range roughly of 370 on SPY to 390, or 3,700 to 3,900.
So Jeff, what you're basically saying is we're rapidly going nowhere the last few weeks.
Yeah, Phil had this awesome analogy. He used to talk about the drunken crow.
Wait, the drunken crow. I got to hear this one.
The drunken crow. Yeah, I mean, look, I'm in Wisconsin, so we know that everything here in Wisconsin drinks. So the crow would liquor up, and then he'd go flying, and he'd fly lots of miles, but end up kind of back where he started. So we're getting lots of intraday moves, but we're really ending up nowhere. It was funny. I did my last video back on the 23rd of June, and then I did one last week. And people were saying, "Are you going to do one? Are you going to do one?" And what's interesting is we were within a point of the 23rd. We were at 378 on the S&P or SPY, and last week we were at 378 as well. So it's just really
Yes, Jeff. Let me jump in there.
Yep.
So what you're talking, you're triggering me. What you're referring to, and I see this in so many stocks now, where the thing collapses and it's quote unquote oversold, whatever that means, and it quote unquote should bounce. And inability of these things to bounce very much so far, maybe they will bounce, to me is very revealing. It's sort of like, I'll use another analogy. It's like the drunk who falls down a set of stairs. He stops falling down. He comes to rest on one stair, but he tries to get up. He can't really get back up very much. And like the longer he's unable to show any signs of life and getting back up, the more you can be convinced that the direction is still flat to down. And so I look, and again, this, we may look back on this as, oh, remember the day George was giving Geoff a hard time? No, I'm not giving you a hard time. I'm just wondering out loud. I just kind of wonder, when you see something that it has no mojo, just has no get up and go, and by all accounts, because it's quote unquote oversold, it doesn't rally meaningfully. How does that, what does that mean to you?
Yeah, we have lots of stocks in that situation. I'll take an example of a stock that we've had on our short list in the past, and I don't have it on right now because I'm just kind of watching it. But it did exactly what you said. Restoration Hardware. We got shorted in June and made some really nice money, and it kind of went from let's look at the peak in June. We were at a high of 314, then we went down to 237. So percentage-wise,
and I'm going to give you air cover. Ignore that spike low. Put your finger over that spike low. I think it was a closing low of 215 or something like that. It doesn't count, all right? But in the bigger scheme, there was like a few days where it got down to 215. But in the bigger scheme of things, like the real low is kind of in this 240, 250 area. This thing, then maybe it'll break out from here. But so far, keep going. This is a perfect example of what I'm talking about. Keep going.
Yeah. So this stock technically is ranked. So we rank stocks technically, and here's what we do. It's a pretty simple idea. We look at how stocks are trading over the last 100 trading days against the S&P, and then we rank them from 10% to 100% in 10% increments. And what Phil did years ago, I mean, this is back in 1992, he used a technique called cohonent layer mapping, which is like barcoding, and he fed the computer all these price charts. And then we basically said, okay, what are the 10 most prevalent price charts? And let's just rank them from 10% to 100%. So as I mentioned earlier, we've got 5,400 stocks in our universe. What we don't do is throw 540 stocks into each of the 10 baskets. So right now, a lot of stocks are underperforming, which means 10 to 50. We probably have 4,000 stocks on that side of the ledger, and then we've got 1,000 that are ranked 60 to 100 that are kind of outperforming right now. And so this thing, it's rallied from 237 up to 264, but the rank is still at 20%. And people will say, well, there's going to be a short squeeze coming in this thing without even looking at it. And the point is, our short intensity, which looks at the range of short ratio, is at 12%. And the short ratio is at 3.25. And then the absolute number of shares is on the floor. We're down to 2,170,000 shares that are short.
So Geoff, in your words, is this type 4?
This is a type 4,
Hey,
correct?
can you just explain to the room how your system between the ones, twos, and threes and fours, how you divide the market?
Yeah. So a 1 and 2 are stocks that are strong technically, and the 1 also has lots of shorts in it. So let's do my favorite long idea right now is Visa. The shorts have been coming into it, and technically it's at an 80%. The short intensity is at 90%, and it's 3.88 days to cover on the name. So that's a great example of a short squeeze. And historically, what's so interesting about this is, so not only can we tell you it's a short squeeze, we can tell you how the shorts have done. And in the case of this stock, the shorts have never made money. Like 5 times they've tried to short this thing since it's been public, and the average loss is 26%, and the average number of days that they're short is 288 days. So they're stubborn shorts, and so far they're losing a couple percent, but they're still like 20% upside on this thing, which would take it ultimately to 250. So that's a one type 1, a short squeeze. A type 2 is doing well, but no one is short. It's amazing the number of times I hear people say like, oh, this is going to be a great short squeeze. But I look at it in our work, it's a type 2. It just doesn't have the shorts in it for one of two reasons: or the absolute number of shares are not even close to the high, or the volume is so much that it takes the short ratio down, and it's easy for shorts to get out. This is going to become a problem at some point from here until we end this bear market. Is the shorts are not going to be able to get out, because the next type of stock is becoming more prevalent in our work, and that's a type 3. It's weak technically, and lots of people are short. George, you know this from last week. I'm going to kind of hit on this one as a good example of it. Is TD, the bank north of us. It now has a short ratio of 20.29 days to cover, and the short intensity is 100%. So let's just think about this idea of what a short ratio is. It takes all the shares that are shorted and average volume. We do average volume over the last 12 months, so we smooth it out much differently than New York Stock Exchange does. They do it over the last 20 trading days, which makes it look really whippy. This follows it really nicely, and so that says it would take the shorts 20 days to cover. Well, last time I checked, 20 days would be a month. And if the shorts were actually competing against longs that want to own this thing, I'd say at a minimum you could use a multiplier of 2. So that means it would take the shorts 40 days to cover their positions based on average volume, unless they just want to blow it out. And in case they decide to do that, let's say they want to blow out 20 days worth of volume in a single day, the stock will be back at $85 in the blink of an eye. And so what the type 4 is weak technically, and no one is short. And that has been the demise of people that have been long stocks that have ridden names down to lower levels. And a lot of times the reason that people aren't short stuff is they think that it'll recover. Probably my classic example for this year is Netflix. It started the year at 600, and it's now at 197. So you'd think it'd be a great stock for the shorts. The shorts did write it down for part of the way. They wrote it down to 350, but since then they've been gone. So it's been a long squeeze from 350 all the way down to like the 170
Yeah.
level.
So Geoff, let me interrupt you there. So Netflix, this is a real beauty. I love this chart. So some of the stocks we're talking about that crashed and they haven't really done anything for a month or so. Think about Netflix, which is so awesome. It crashed in late April. All right, so here we are, 1, 2, 3 months on. It hasn't been able to do anything. But I want to offer up Netflix as indicative of bigger trends. So if you look at the Goldman Sachs Hedge Fund Hotel Index, I had it in my feed. I'll put it up in the nest a little bit later. That's all the stocks which are most widely owned by the hedge funds. Those things, in absolute and more importantly relative terms, have been a complete freaking disaster. It's exactly what you're saying. So, I mean, I don't know if you look at that index per se, but you know what I'm talking about. It's all the
Yep.
over-owned names, and so the Chase Coleman's of the world. And yes, I do name names, unlike polite people in other rooms. I do name names. All the lazy longs. So let's just all right. You don't have to name names, but when you look at that Goldman Sachs hedge fund hotel index, and it's all the Facebook, the Netflix, the Microsoft. Let's not get caught up in individual stock names. You know what I'm talking about, right? So
Yep.
everyone thinks they're good stories and they're cheap and blah blah blah. Is that not a perfect example of what you're talking about?
Absolutely. Absolutely. Good example right now on my list for this week. Every week we do a list of our favorite longs and our favorite shorts. And the one thing I'll say about the shorts right now is that we do a model short portfolio. It had 4 shorts last week. It's got none this week because the risk of a move is definitely there. And what I've tried to do with the long squeezes for this week is lower beta, high market cap. Here's a great example of a stock that's not participating today. Look at LMT, George. Um, Short intensity is 6%. The short ratio is 1.55 days, and the tech rank is at 30%. So it's a long squeeze in our work. And guess what? It just broke the 200-day moving average for the first time in since it was below it kind of last year in the fall when it missed on a quarter, and then it kind of got back above in January, and now it's broken again. So this stock is just not participating, and everyone owns this name, and so it bounced off of 375. It'll be interesting to see if 375, holds on it. And what happens is this tends to be like there's a great way to do pairs on this type of stuff because, as an example, on the opposite side is General Dynamics now. General Dynamics now has short intensity of 100% and a short ratio of 3.24, and it's got the same tech rank at 30%. So an interesting way to pair this stuff up is if it goes from being a 3, the only place for it to go if the shorts still stay there is it to being a 1. So if and when you get improvement in GD, that would be an interesting pair trade to say, hey, I'm going to go long GD and I'm going to still stay short LMT. So that's kind
Right,
of a quickie
right,
summary.
right. So Geoff, let's zoom out a little bit here, and we'll get to some questions. So let's put yourself in, if you can, in the position of the average listener in the room, someone who's trying to just figure out what the heck's going on here, and
Yep.
the market's not working out the way the nice man from Fidelity said it was going to work out, and the 60/40 portfolio is not working. And I mean, I was blown away by the numbers you threw out at the outset. I kind of got lost in the numbers, but the one takeaway was I was like, oh my god, it's like almost impossible not to have lost money. Those statistics you threw out there are mind-boggling. So for the
Yeah.
average
Well,
person,
George, remember this? We were talking about this a little bit last week. So Tom Thornton, his message page on Bloomberg, a guy had said that his daughter, he was complaining about the market and how tough it is, and she just said, Daddy, why don't you just buy stocks that go up? and guess what? Only 16% of
I
stocks are
know,
going up.
you got no shot. Okay, okay, okay.
Those are not very good odds for people right
Okay,
now.
okay. So Geoff, I'm going to answer. I'll ask you. You can answer any of these questions you want to. Like, I could ask you, what do you think of the market? What do you think of sectors?
Yep.
So, but rather than that, because the market's a collection of stocks, what are your strongest convictions now? It may be the market's going up, the market's going down. It may be the energy's going to crash more. Maybe tech's going to rebound. I don't know, but like, there's some, as the Yogi Berra likes to say, predictions are difficult, especially about the future. So, like, to the extent you have strong convictions, let's recognize this market is made, it's humble to all of us. All right.
Yep.
What kind of is noteworthy in your view?
Yeah. So we've been talking about short interest, and the way that we at Erlanger look at the world is the following. We have setup indicators. Short interest is a setup indicator. We just talked about the idea of short squeezes and long squeezes. A subset of that, which is also a nice sentiment measure, is options. So we look at options activity. And what was interesting, back at the bottom last month, we had really excess put activity. Basically, we have 24 sectors, and all 24 of them had an Erlanger option rank that was above 70, which means the put activity is high. And that options rank is a really cool thing because we look over the last 2 weeks at the options activity, and it's done on a median basis. So if we have one day of crazy volume, that number gets tossed and we don't look at it. So it's got to be really consistent put activity occurring. And so now we're down to only 4 sectors that have the average option rank. So the quick, easy bounce off of the low, that trade has come and gone for like the fifth time this year, and the three that obviously where it kind of held. The one area that's interesting, that's horrible in our work right now, is energy. It broke down pretty nicely, but the one thing that's there is the put activity is very high. I can't find a stock basically in the energy space that doesn't have excess put activity. So people, and so here's what our option rank does. It looks at four things: open interest, premiums, money flow, and the total number of contracts that are trading. So if I look at, as an example, let's just look at the big dog. Let's look at Exxon. Exxon is now in a put squeeze because its Erlanger option rank is at 92%, and it has moved above its daily DMA channel. Now, the question is, what in the heck is a DMA channel? The DMA channel is what we use to determine the bias. Okay? Bias, it's a really simple and it's a really, really, really important concept. That means, do I want to be long it or do I want to be short it? And then a subset of bias are what we call triggers. That means, do I want to enter the trade right now or do I want to exit the trade? And we've built a bunch of our own trigger indicators. It would be similar to what Tom Thornton looks at with DeMark type of work. And so the put squeeze is alive and well in energy. So guess what? That's why for this week, I don't have any short ideas, even though it's our 22nd out of 24th ranked sector. There are no shorts in our stuff for this current week on the energy side. So that is one interesting thing. And so, George, the question about sectors, what we do to get a sector rank is really interesting. We take the average tech rank, so we look at all the stocks in a sector, and then the average short rank, combine them together, slightly greater weighting on the tech side, come up with a number, and then rank everything from 1 to 24. So pharma has been pretty consistent for a few weeks now, and a subset of that is biotech. So I kind of like that space as well. Interestingly enough, healthcare equipment and services has been pretty consistent after being dead forever, like basically all of last year. So that's another space that interests me on the long side. And also, interestingly enough, diversified financials is ranked number 8. So it's still in the upper third of our work. And what's also come down on the opposite side of that is insurance. And having covered financial guys for a long time, I know that when insurance falls apart, that's because it's no longer defensive and people are coming out of that and they're coming into diversified financials. And so, again, my favorite idea, which isn't a pure diversified financial play because it gets grouped to software, but you know what? It's basically theirs, is the Visa idea. That's my favorite long idea. The banks aren't there. Far too many of the banks right now are long squeezes within the work, and we don't have the quite enough excess put activity to say that, okay, they're going to bounce now. It's really amazing that no one is short these. Just to, like, a couple examples, JP Morgan, short intensity of 20%, 1.28 days to cover. Morgan Stanley, 31%, 1.78 days to cover. Wells Fargo, 12%, 1.14 days to cover.
So Jeff, you're saying that the banks, no one's short, so that sector, and they're poor. So that you don't like that sector? Is that what you're saying?
Yeah, I don't like that. I don't like that sector, and the options haven't gotten extreme enough
Okay,
for me
all
to
right,
be a buyer.
okay. So you blacklisted or redlined the banks. That's fine. Energy, you said it was technically crap, but we had a put squeeze. So, like, is energy just not actionable right now for you, long or short?
It's like what you talked about, like the timing that Tom and I do. Like, yeah, we might get a rebound this week. It might last, 1 to 2 weeks. What I said like a week ago, someone was making a comment about, oh, we're going to have this great monster move, blah, 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 to the upside. And like I put this up on my Twitter page. I just basically, it was like over a week ago, I said, all rallies so far have been ephemeral.
Yeah.
And we got that again, like, let's say, how's this week going to evolve? Yesterday was not a great day. Today is a decent day. The one thing though, that is like a bit of a pot, we're hitting on these little nuggets of things that are potentially positive. One thing I'm really interested to see is so far in July, we've only had one day where we've lost more than 1% on the S&P. And I can't tell you how many days we had in each of the previous months, but it's a bunch, somewhere between 5 and 10 each month, basically.
Geoff, a few more points I want to get to, and then we're going to go to questions.
Okay.
Could you speak a little about seasonality in your work? I think you spend a lot of time on that.
Yeah.
And what, and again, when something, seasonality is a condition. It's not a rule. Something has to happen. But when something doesn't happen, which historically does happen, that's informative. So right here, right now, what are you thinking about seasonality, Geoff?
Yeah, so George is correct. We do seasonality work, and I would consider that to be the third leg of our setup indicators. The first being short interest, second being options, and third being seasonality. So what we do is we go back 15 years and we look at how stocks traded over those 15 years, and then what we do is we look at the 7 oldest years and the 7 most recent years, and if it was say 12, we had 12 years of data, we would look at the oldest half and then the most recent half and say how they did. So the first thing we want to know is, does a stock have a seasonal tendency right now? So what's interesting, if we look at SPY, SPY is basically the market. We're in a positive cycle now for seasonality that lasts until the 26th of July. And last time I checked, guess what? Is it next week, the 26th? Yes, it is. So then we struggle seasonally, basically open-ended until the 17th of October. That said, there is a little bounce that occurs the very, very end of August into the middle of September. And what's kind of funny about it, it ends like basically right at my birthday. I guess that's a birthday present for me to know to only buy puts, right, George? So that's where we are from a seasonal standpoint on the market. And what we really like to do is kind of combine all of the stuff we've talked about so far: short interest, options, seasonality. So if I look at the S&P 1500, how many stocks right now are basically short squeezes or close to being short squeezes, high short selling, that would be considered to be buy ideas? And that number is roughly 20 names. So it's not very big. And if I went and looked at what was seasonally weak, S&P 1500, this list is probably 200 names right now. So that tells me a lot when I do screening work to look at what names are seasonally strong and technically strong working, and what names are seasonally weak and underperforming. That is a big tell. George, does that answer your question on that?
Yeah, and by the way, when you look back, when you go through that type of methodology, and it's not every month, every year, but when you over time, if you were to favor the stocks that were seasonally strong and were technically behaving well, and short the ones that were seasonally coming into a weak period that were technically weak, is there usually pretty good alpha in that type of approach?
Yeah, and so so right now I'm kind of mixed. If you had to ask me where I was on a scale of 1 to 10 and wanting to own stocks, I'd say probably like a 5.5 now. But when we get into this next seasonally weak period, how scared am I about that on a scale of 1 to 10? I'm a 15. And why am I?
Okay. So short run between now and the 26th, what you're telling me, if I got you right, I'm not putting words in your mouth, you're really playing the short game with the 26th. I mean, you're rearranging the deck chairs on the Titanic, and you're much higher confidence. So you're a 5.5, but you're much higher confidence as looking out between now and October. In your world, you think there's a big down coming somewhere. Is that what I understood correctly?
Yes, potentially, and there's a really good reason for it, and it's something that I've tracked historically for like the last 10 years, and it's because when you move into it used to be really, it could move up a little bit in time period this time, but second half of August, September, and kind of the first half of October, that's traditionally when the mutual funds do their tax selling. If we went back 10 years ago, almost all the mutual funds were on a fiscal year end of 10/31, and a lot of them have moved it up to September, so 9/30. So that means they have to have all their tax selling done by 9/30, and that's what causes potentially weak periods or crashes. It's interesting how most crashes are October events, or a lot of them are October events. And given that we only have 16% of stocks up, the thing I want to see is once Q2 holding numbers are out everywhere, is to take like 5 of the bigger mutual funds and see if they've been smart about this and sold when things were bad, or if they're waiting for like this bounce period potentially, and then they're going to try and sell stuff. But historically, the bad falls have come when you've had more stocks down than up. So yeah. So George, that's the thing that causes me to wake up at 3 o'clock in the morning and say,
Got
"Oh
it.
shit, I gotta be looking at I gotta look at where futures are right now, because it's going to be a down 4% open in the morning."
Right.
Contrary to that, though, which is really interesting, is we have a lot of, well, on this hand there's this, and on that hand there's that. The one other thing is the shorts have gotten so confident in what they're doing, and the short selling is so high now that if certain things were to happen potentially, you could have a monster squeeze as well. Now, I don't see any signs of that. To me, I see the occasional day where, shorts get penalized. Like today is a good example. Like probably 90% of the threes are up today, and even the fours are up just as much. The interesting thing is, off of complete bottoms or lows, the fours typically outperform the threes, which is kind of an interesting thing. That the fours are a lot of times good companies, but they've just gotten weak, and people just decide not to short them. So when they come around to do the bottom fishing, that's where they tend to go. And the threes are only as good as the short squeeze is in those names. So the one thing that we have to kind of respect now is that the shorts are very confident. Anecdotally, I could give you lots of stories about that. But it's starting to remind me a little bit of March of 2009, from the extent that when we started to rally at 666, the shorts didn't even think about covering until we got up to basically almost 1,000. So I think it was like 975 in July, and that's when they started to cover the positions. Because the thing that people kind of forget, like a lot of those shorts still made money because they were shorting at like, even higher levels. So they were willing to accept some pain. And I think there's a lot of that right now, where shorts have made incredible amounts of money. So let's say they're up, like, pick a name that's like down, like Scott's Miracle Grow is a great name. It's down like 50% right now. I think over 50%. So let me just look at that chart here really quickly. Just use this one to get people kind of thinking about it. Come on.
While you're looking for it, Geoff, I'll just say, listen to you talk about how maybe the shorts have gotten over their skis in the short run, but longer term, you're very concerned. And by the way, for those of you who are interested, we're having a room on this Thursday at 11 a.m. with Walter Deemer. I'm just going to invoke one of his great quotes. I quote, "The stock market will do whatever it has to do to embarrass the greatest number of people to the greatest extent possible." Translate that to current circumstances. Market should like rip, face ripping rally to the upside, force some of the shorts to cover, and then flush the toilet with an epic collapse in the fall. So, Geoff, back to you.
Yeah, so let's look at the SMG example. Like, let's say you got shorted in January at let's say $160, and then it kind of bottomed here at 75, and now it's at 84. And let's say your stop's at 100. You're just going to sit on it, and you're not going to provide the power that you need to be, because at like 160 down to 60, you still got a really nice gain, especially in the world of short selling. The way I think of short selling is a single is making 0 to 10%, and a double is 10 to 20. A triple is 25 to 50, and 50 or more is like a home run. But how many really good short sellers historically, of all the trades they do, are you there? Sorry, I had a call come in.
Yeah, we lost you. So Yes, so Jeff, hold on, I have to go on slightly different. Sorry, did you finish the thought? I didn't
Yeah.
mean to interrupt you. Go ahead. Go ahead.
Basically, on the example of Scott's Miracle Grow, like it's 84 this morning. Is the guy who shorted at 160 feeling pressure? The guy who would be feeling pressure is the guy who shorted it at 75, and it's now up $10. And if it goes from 75 to 100, he's down 33%. But the guy who shorted it at 160 is still making a lot of money. So,
100. All right.
that's where
Yes.
we sit like today. Um,
Right.
and I think the idea is, I love how like people get put into holes of being like a bull or a bear. I just consider myself to be like a dog. I chase the ball.
Yeah. No.
I'm chasing the ball and trying to figure out
Yeah.
where the
No.
ball's going.
Yeah, and that goes to the Jesse Livermore quote about there's not the bull side or the bear side of the market; it's the right side of the market. We just want to make money. So let me just throw. By the way, I like again we're speaking. Let's just reset the room here. We're with Geoff Garbacz at Quantitative Partners, probably the country's leading expert on short interest data, a really good market observer. If you're interested, please reach out to Geoff. His service is Quantitative Partners. They have a lot of clients, institutional, some of the biggest, most sophisticated institutions down to individuals. And I'm sure if you're interested, Geoff, you can work something out with Geoff. So Geoff is giving us a sort of his views of the market. Please raise your hand if you have a question. Geoff, I'm going to throw a couple particular names at you just because they're timely and I'm sure the room's interested. And they're coming out with earnings shortly. So one is Tesla, two is Apple. So what are your thoughts on those two names, please?
Yeah, so Tesla, it's interesting. It got down here in June. It got a little over 50% short intensity, a little bit of covering it. It doesn't have a big short ratio. Um, it's only around one, and a lot of the bigger stocks. But now, what's interesting is the absolute number of shares have fallen incredibly in this name. We're now down to 27 million shares, and August. So 2 years ago, it was at 70 million shares. So that's why the short ratio has come down to such a large degree. So this stock is it's a long squeeze in our work right now. The tech ranks at 20%. The short, no, it's not quite there because the short intensity is a little bit too high. It's at 49, but then the short ratio is at 1.07. So it's a quasi type 4. The thing that it had recently in this kind of June and July period, we had a couple up down moves, and those are driven off of excess put activity. But now that's kind of gone away. So I'm not a fan of this thing.
So that's Tesla. Let's move on to Apple, please, and also that may be a good place. I mean, you and I talked about Apple earlier. So,
Yeah.
What do you think technically about Apple? And also, you had some comments and some thoughts about what they did yesterday.
Yeah, so it's up today like 1.8%. It's well off of the June 17th low, and now the question is, does it break through $150 and then go higher? And I see the 200-day moving average is at 158.39, so that's going to be a bigger deal. People have been shorting Apple, interestingly enough, since April. And let's see, how many shares are there short in Apple? Yeah, we got 112 million shares short in Apple, but the thing is, it trades so much every day that it's only 1.29, but the short intensity is there. So what I like to do, and by the way, there's no put squeeze in Apple right now. And if we look at the seasonality, it runs into September, October seasonal weakness. Not as much August, but it's more a September phenomena. One thing that we did about 5 or 6 years ago is we quantified how the short sellers do. So as an example, I can look at Apple and I can see, well, how have the short sellers done in Apple? And now we've got moderate short selling because we're above the 50% level. So historically, the shorts get squeezed 61% of the time, and then the shorts make money 39% of the time. But the difference between the two isn't that great. The average squeeze is 11%, and when the shorts make money, on average, they make 8%. So there is some validity to the idea of smart short sellers existing in Apple, not hugely, but decently, and it's something that I would be aware of. And George and I were talking this morning about Apple as what happened yesterday, because effectively they they cut corners on Reg FD yesterday and kind of leaked what was going on at the company in certain units where there's going to be issues. And then when it was leaked through Bloomberg, so they're considered national media. And so they put out on Bloomberg.com 2 paragraphs, and then for the Bloomberg users, they gave them like 16 paragraphs, and then 3 hours later, they decided to publish the rest of it. To me, that's like a company playing games, and it's kind of surprising that they would do it. So I think this could be an interesting stock, and clearly it's a market stock too. It'll drive down the S&P, but our tech rank has never gotten above 60% since. It's gotten 60% a couple times and failed, but it hasn't had a strong ranking since the end of last year at 100% in December when it was like $180. So I don't know.
So is Apple a pair of twos, or would you be leaning long or short right now on Apple?
I'm just kind of neutral on it. But if I was
Okay.
if I was an aggressive short seller, like, to me, this is an ideal point to put on a short because it's right below $150. If it breaks at $150, people are going to sell it, and if it goes up above 150, people are going to want to own it. The one other thing that we do, George, which is really, I think, great work, is we have our own money flow. It's called the Erlanger volume swing, and it's slightly positive right now. But the weekly is still. Hang on, I'm just pulling up the weekly here. I want to make sure I'm speaking correctly. Yeah, the weekly is still negative. That's what's so interesting about almost every stock right now. Remember, only 16% are up for the year. And yeah, you can get stocks that have positive volume swing on a daily basis, but very, very few names have come back above and turned positive. The only time they kind of did it this year was in the March kind of turnaround on a weekly basis, but we're still at a minus 8.39. Yep.
Got it. All right, that's great, Geoff. All right, so now let's open it up. Again, we're with Geoff Garbacz, Quantitative Partners. Geoff is the country's leading expert on short selling and a great market observer. So, Marcus, welcome. What's your question, Marcus? The floor is yours. Please unmute yourself. Marcus, are you there? I guess not. All right. So while we're waiting for other questions, I'm sure somebody's going to have a question here. So, Geoff, for the average person at home, like, who's not going to be trading this thing week in and week out and looking at, Tommy Thornton's, DeMarc signals, all that sort of stuff, what would you tell them? Basically, wait for a better pitch to hit. Let's get through this potential for a significant down in the fall, and maybe once you commit to the market, in October, once the dust is settled. Like, what would you tell the average investor if you were sitting on the investment committee, of a charity or something like that, where they're not day trading this thing, okay? And maybe they're moving money quarterly, annually. I don't know, like, or maybe they got some cash in. Someone just gave them a big donation. Would you be waiting till October before you put the money to work? Like, how would you approach the market, Geoff?
Well, one thing that's a good way to look at stuff is dollar cost averaging. And with, like, some of the stocks that have been really crushed, that's not a bad approach. And what I would say for the individual is, we have an indicator, which I've talked about a little bit, and I'll take it out to the periodicity where it would work. I call it the Warren Buffett. We have an indicator even for Warren Buffett. It's the monthly DMA channel. So until the monthly DMA channel turns positive again, I think you can just sit tight if you're like the average investor. You may not get like the absolute low, but you'll be within 10 or 15% of the bottom. And so that's another way. So there's average costing, following the DMA. One thing, George, I like to do, and this is a positive. I have a thing called the bottom fisher. Okay. So we all know what bottom fishing is, trying to get stuff off of a low. And the way I do it is I take a weekly DMA channel and a monthly DMA channel. So the whole idea is if you're in or above the weekly channel and you're below the monthly channel, and the relative, Phil also, like, if he had one indicator to use, he would say, I want to use relative strength. So we look at relative strength against the S&P and relative strength against the sector that it falls into. And then last, we look at volume swing, which I'm talking about. So there are like the list of stocks that are potentially in bottom fishing situations right now. It's like 1,300 stocks, which is a big number. There's a lot of stuff that is interesting. The one thing that is interesting to me, I hate this idea of like the buy of your lifetime, right? I don't believe in buy of lifetimes, but I do believe in like the buy of a decade. And we know that you had your buy of the decade in 2009. You could make an argument maybe then in 2011 or 2015 or after the fourth quarter of 18 have been kind of those type of opportunities. Are we there right now? Maybe, but also maybe not really, just because the internals of what we look at, we when we do our weekly work, George, it's like going to the doctor every week and getting your blood pressure taken, your enzyme levels, etc. And none of that stuff is like positive right now. It's just a real struggle. Nothing's looking good. So those are a couple different ways for people to kind of play it a little bit.
I hear it. Okay, so hold on, Marcus, are you there? You got your hand up. I don't know if you disappeared. Marcus, what's up?
Sorry about that. Thank you again for the spaces, John. George, amazing. I have a quick question with option activities and the selling out of the money short-term put activity. Have you seen any spike, or do you typically see a spike when we usually get a flush into the market? Thank you.
Yeah, I mean the put activity spikes as we go down, absolutely, and that's how we know we've made like a short-term bottom, and then we're gonna bounce. It's almost flawless because we can also do this not on a stock by stock basis, but also do it on the sectors. So as I mentioned early on, I was saying how we had 24 sectors around like the June 17th low, and that's been kind of dropping off now. Now we're not at a level where it's excessive. So yeah, it does a really good job. What's interesting, what doesn't do a really good job is the call activity. It just kind of stopped after that 2002 period. It does a great job on individual stocks. Like Apple, it's almost flawless when the call activity gets excessive and it's had a big run. It's going to pull back. But as far as using that as a market timing tool on the entire market, excess call activity, that doesn't really work. But on the put side, yeah, it works really great.
Thank you for that. Sorry.
Okay, so let's go to KFAB and then Dave Nikoski. KFAB, good to hear from you, my friend. What's up?
Hey, George, thanks. Jeff, nice to speak with you again. Do you do any short selling work on international ETFs? And if so, are you seeing anything of notice there, given all of the wonderful events that are unfolding beyond our shores?
Yeah, so we don't track every single ETF because ETFs are now kind of like tribbles. They get, if you follow Star Trek, remember the tribbles? They just came out and they bred everywhere more than even rabbits. I mean, ETFs are being created every single day. What we do is we do track the major ones and look where short selling is, and then we combine it with our technicals to have a good idea. And we use that for just overall take on the market. And right now, all the foreign ETFs, basically, with the exception of China, look really kind of very weak in our work right now. I would say that the daily, if I looked at like EEM or EFA, those are okay. But the weekly and the monthly are just really bad. And interesting, China is bad now daily, but the weekly is kind of still okay and the monthly is still bad. But across the board, looking internationally, almost everything is still really bad weekly and monthly. Interesting, like I just pulled that screen up to look at it. This is the first time that the weekly has been inside below, from below, which is a big positive. On the Dow SPY, ONEQ, which is the NASDAQ Composite ETF, MDY, and IWM. So that's kind of an interesting development with today's action, kind of pushing back again in 390 or 3,900 on the S&P 500. So KFAB, does that help you?
Yeah. Yep.
Okay.
Thanks.
Great. Thanks, KFAB. Mr. Nikoski, Dave, good to see you, my friend. Another solid, clear-thinking Midwesterner. By the way, so Dave, I got to ask you: is this Minnesota Wisconsin thing? Is this like a rivalry? Like, what's the deal?
I'm sorry.
We fight for the axe,
George.
We fight for the axe, George.
You fight for the axe. So, Nikoski, what's your take on those guys from Wisconsin?
Wisconsin?
Yeah, Wisconsin.
Well, I was just through Wisconsin last week, and everything looked good. I drove through the UP up in Michigan. If no one's ever been there, absolutely beautiful country. Untouched, Great Lakes surrounding it. It's gorgeous. Great place to go vacation.
But is any of that stuff being run over by people leaving the city? Give us, before we get to your stock questions. So, like, someone was telling me the other day, like, some of the same stuff you see on the East Coast where people are fleeing New York or Boston and going to, like, the Cape or the Hamptons, whatever. It's overrunning all these places which were relatively, less inhabited. And is the same thing happening in the upper Midwest? I mean, I don't know.
Absolutely.
Talk to me about it.
Absolutely.
Yeah. Minneapolis has turned into quite the crap hole. I have a place up in northern Minnesota in the lakes area with, probably 50 lakes within 10 miles. And it is being run over. I know that area, the Brainerd Lakes area, as they call it, last year was the second highest appreciation in home prices in the country. But realize we're not dealing with home prices like you have on the East Coast. So, something in the $1 million range buys you a place on the lake, whereas you're in Boston or New York, it's a 1-bedroom, 1-bath house, right? But it's gorgeous, but we're seeing a lot of people in the northern areas and the outskirts, 2 hours north of Minneapolis, are absolutely going rampant. And you're seeing a lot of people just retire, and retire out, up in the northern tundra. So.
The frozen tundra. There you go, Nikoski. All right.
Well, and George, on the other thing on Wisconsin, it's interesting. Green Bay, if you look at a map, you'll see this kind of index finger that juts out into Lake Michigan. It's a peninsula, and that's called Door County. And Door County is basically the Midwest equivalent of Cape Cod, and except the water, you can see down 10 feet in Lake Michigan up there, as opposed to seeing 6 inches and not knowing whether you're going to get bit by a shark on the Cape now.
Yeah, and most people think of the Great Lakes. I did I was a Boy Scout leader for years, and I took several kids up there into what's called the Apostle Islands outside of Bayfield. And you can literally take a glass, dip it in the lake, and drink it. It is that clean. It really is. It is amazing. The water temperature is 34, 35 degrees all year long. And it's cold as heck, and it preserves any shipwreck or anything like that like you wouldn't believe. So it's a beautiful area. Absolutely gorgeous. But hey, Geoff, I've got 2 questions for you.
Sure.
You mentioned that so I do very much the similar thing that you do, and I utilize relative strength, break down the market, follow, a little over 5,000 stocks in the U.S. and about 7,000 stocks broken down by geographic region, sector, and group. So you mentioned that you have 28 sectors. How did you compile, and where did you get 28 sectors from? Because we have 12 sectors in our product, and we have 440 industry groups broken down within that. Second question will be, the U.S. dollar. How does that compile into your analysis? And let me give you an example. 2002, once we saw the NASDAQ, complete its downfall, in 2002, you broke the dollar uptrend because it was the only place down. It's much like we see here. My concerns with that would be that, back in 2002, I was working with my father, Ed Nikoski, who put out a call on that very day of that crack and said, we're going to see a major decline because you're going to see, governments and central banks around the world repatriate money. And of course, it's going to, in my opinion, it's going to determine how fast the dollar moves down from its precipice. But it was a great call, and that's what led into, the 2002 cracking, making the low in 2003, and then building a nice base for us to project up from at that point. So I hope that kind of gives you a little idea of what my question was.
Yeah, so on the first part of it, so we do not 28, we're 24 sectors,
Okay.
S&P subgroups, and then we do 146 industry groups. So as an example, in tech, our sectors are software, semiconductors, and then hardware and equipment. That's what our three sectors
Okay.
make up. And then, like as an example for semiconductors, we do semiconductors as a group, and we do semi equipment as a group. And so those are our two groups within that.
Okay.
And then we take all of our information, roll it all up to do ranks on that stuff. And on the dollar's a good example of what I call our bias. So the bias on the dollar, we use the DMA channel. Let me explain this to people so they kind of understand it conceptually. For whatever period we're looking at, it's a 6-period moving average, and it's offset into 4 periods going forward. So if we were looking at a monthly chart, it would be a 6-month moving average offset into the future by 4 months. And then what we do is the upper band is from the high of that period, and the lower band is from the low of that period. So that's what sets the bias. So clearly, right now, the bias on UUP on a pretty much every period right now is positive. I mean, we got above 29 on UUP. We got to come down to 27.79 before I would even say that, okay, the bias is changing on the dollar. And obviously, because of ETFs now, we can track, this against every ETF as well, currency ETF, and see how they're doing. And then our trigger stuff, we have a couple price momentum-y type things that we use: ETS confirmation, EC spread, Erlanger trend direction, and then we have our own volume stuff as well. So that's positive also. And one thing I like to do is just tracking, if we're talking about currencies, is just how the dollar is doing against the S&P. And I found a really good one against Bitcoin. And I'm not gonna tell you what it is, but it's a relative strength type thing, and it's comparing two things. Yep. And it just gave a buy signal in the last couple of days. So to me, it looks like the worst of the damage for the time being is done in Bitcoin.
Thanks for that,
I'm
Dave.
not a crypto fan, but I would agree with you. Since I use relative strength and we use it in our own manner, that works for us. And I agree with you on the biotechs. I've been an early proponent on the biotechs for a couple of months now. So definitely seeing that. And good. I'm seeing some signs of life in retail. And I know George is going to give me flack at it, but I've got a number of names popping up. Whether it's golf or Crocs, look like they're making some bottom. So I don't like to throw out individual names. I don't own them, but that's what I've been, discussing with clients.
It's interesting. So. Retail in our stuff is bottom of the barrel still. It ranks 19.
Yep.
Now I will say this: consumer durable / apparel is better. It's at 12 right now out of 24, so it's just middle. But the bigger type retail stuff is and if I sort it by market cap, let's say I go by like the bigger market cap. Interesting, like there are some names that are okay, like Home Depot is okay, Chinese stuff is in there, TGX is looking good, Dollar General, O'Reilly, AutoZone.
Yep.
Those are the type of names that work.
Those have
but
looked
then
well for quite a while. The O'Reilly and AutoZone.
Yep.
On a relative basis have been absolutely stellar.
Dave Nikoski, let me ask you a question. So,
yes,
I remember we were together in a room about a month ago. Michael Belkin made the sell call on energy. You were like, yeah, anytime something gets to be so over, you weren't making the sell call necessarily, but you were like, anytime something gets so extended above a moving average, it's like, it's not a good entry point. Yeah, it could easily correct, blah, blah, blah. Okay, well, that happened quickly. So here we are. So for someone who doesn't think you're a genius because you got it right, or doesn't think you're an idiot because you got something wrong, who's meeting for the first time, you go to meet a new client, they say, Dave, what do you think about energy? What would you tell them now on energy?
Energy right now.
I'm sorry, you broke up. Say it again, please.
I'm a buyer of energy now. My price target, when we had that discussion, 200-day moving average was at 93.50. I said, 98 to So you can always, you know, individuals, when they want out at any cost. And we dipped, you know, one day through that 93.
Hey, Dave, you're breaking up on us. You're in the matrix now. Dave.
I'm trying to get out of the matrix.
Oh, there you go. Okay. So you were saying
yeah.
we got down to that level. Okay, and then we lost you. Go ahead.
Yeah. So, you know, I thought that we would probably come back into the 93.50 level. And, you know, whether it's 93 or 94, you know, it's close enough. And it depends on how wide of a marker I'm using to draw up my lines. I think that when, you know, if you're on the other side of the world, or we were suffering the same pattern that Europe is, that you don't know if you can fill your car, you don't know if you can get a gallon of gas. I think that there's a premium to at least safety and security. From a military standpoint, I think draining the SPR has kept us in check with where we are at. And once that's gone, you're going to lose that. I think that you're going to see, you know, a lot more onshoring here in the U.S. I think that's going to drive energy demands up. You know, I would stay away from housing, the automobile.
Right. But Dave, speaking of short, do you think we've seen the correction in price? We just need to build some bases. You think you could put your toe back in the water, or would you wait?
I think you can put your toe back in the water. But I wouldn't go, you know, bring it up to, you know, we're overweight in energy right now. And
yep.
I would say you buy on the pullbacks only. You don't chase it. Let things soften out. You know, I posted a chart today, which was interesting because we hear of this gas demand destruction. I think it was Belkin that also posted that.
Hey, Dave, Dave, you're in the matrix again. We can't hear you at all. I'm sorry.
All right, can you hear me?
Hey, George, do you want to just move on a little bit?
Yeah. Dave, you there? If you're in the matrix, no. If you're out of the matrix, yes. Dave,
I'm here.
You're okay now.
Me? Okay, I'll keep my arm out the window. Yep. I'm driving.
Go on.
You know, when I pulled up the Baltic Dirty Tanker Index, you know, that's still climbing, and we're still near 10-year highs. It's done nothing but go up for the last month, and it's not showing at least oil demand is subsiding, at least on a tanker basis.
Right. So you put your toe in the water. That's cool. Yeah, Geoff. Yep, Geoff.
Hey, George. So I would say I'm not as sanguine as he is, and clearly the price is the driver. I had a research guy I worked with for a long time, great guy, Bruce Gulliver, is a PhD, and he found that whether it be materials or energy, the underlying commodity drove like 80% of the price. So basically, if you get the direction of oil right, you're going to be a hero, and if you don't, you're in trouble. And so far in energy, when it broke down in the middle of June, and on our stuff, like, it broke down and it hasn't come back yet. And what's interesting is the issues above the 50-day have fallen completely apart. So to me, that would be a litmus test that I would want to go like we were at. In other words, if I look at all the energy stocks right now, there were above their 50-day 222 names. Right now, we got 29 names. That's pretty bad. So I got to see some more improvement before I would even think about coming in, because if you look at like XLE and you get a break here of the $70 level, I mean, you could go to 60 in a moment's notice. And I think the one argument against energy right now with where it is, if it was up at 90, I wouldn't be even saying to worry about stuff. But now they're losers. They're people that came in, you know, basically if you bought energy kind of pre-January or after January, you're a loser. You're losing money now. And so those people their hands are going to be forced if XLE breaks like the $70. And if we wake up one morning and Putin's dead and gone, you're going to get a real big drop in the price of oil. It's pretty much a guarantee.
Yeah,
so there's risk. There's risk. I would say there's more risk.
Yeah, and so you know, as you know, Mr. Energy Tourist, My Life in Times, his autobiography is told to Jeff Garbacz. I get it. There were a lot of like lazy longs They came in at the top, and so yeah, no, totally. So that's a great. Those are really thoughtful responses, both from Dave and Geoff. Let's move on here a little bit. I want to go to Jackson and then Carpathia. Jackson, good to see you. What's up, man? Jackson, please unmute yourself.
You two guys, as Aces would say, get a room, because I love Geoff Garbacz. I wanted to ask really an equity question. Believe it or not, I am a private equity guy, but do participate. Al Levinson got me down the rabbit hole of the Richard Dennis turtle method a few weeks ago. I mentioned it to Tommy Thornton. He said he was kind of getting that feel. Geoff, what I'm talking about is like at the bare bones, as we continue to trade in this range, it's going to take so much energy, positive energy, to get us to go on a run, a significant rally. Where are you with that? I mean, what is the new significant rally? Is it like 4,200? I mean, everybody wants it, but where do you see us?
No, I think we're like this. This is a Starbucks market. In other words, lots of people are going on strike. There's just a buyer's strike right now of owning stocks. And actually, I think the thing gets lit very quickly if people all of a sudden decide to. Let's say we get through 4,000 in the next week or so, and then everyone's like, "Oh crap, I got to get in again because I got to keep up my performance." The one thing that we look at is we love to take our indicators and do it on the overall market. And the one thing that's kind of come back to life, it's in neutral territory from being bad, is the Erlanger volume swing on the market. So this is our own tracking of how volume is, and right now it's a 0, and it was at a minus at the May low. Let's call it like minus. What were we? Minus 18, which is about as low as it gets. And the peak was last year. We were at 12 on the November peak. The January peak was a lot less. So like there is some buying that's going on, but it's small. And I would say probably a small portion of that is short covering as well. So I actually think, it's kind of like the West Coast. You don't get any rain, and then a forest fire starts, and before you know it, it's a 50,000 acre forest fire. That is a definite possibility to the market. And by the way, for hedge funds, that is now the pain trade. The pain trade is a short squeeze, not more downside action for hedge funds. George, you agree with that?
Geoff, you spelled it out, and I'm tweeting out your comment. Do you write your own copy, by the way? I got this. I want to get sure I got the quote right. This is a Starbucks market. The market is seeing a buyer's strike. I think I got that right. No, 100%. 100%. Say, hey,
Thanks,
Jackson, you have a follow-up, or we'll go on to Carpathia. Jackson, you got another one or not?
Not after that. Thanks so much, Geoff.
That's great. Carpathia, my friend, you're up. What's up?
Hey, not much. My little scope, I just saw something come across. The exposure to equities to retail is low, or with the AAI. But it sort of dovetails what the guest is saying. And I agree with Nikoski, on the energy. But I'm actually dipping my toe back in. But it depends on, how you're structured, because I know, George, you caught it. I caught it. So, I went zero energy. And what I'm noticing, and this is, just me watching the futures, and every day oil, there's a lot of days oil opens down, and here's another one, turns green. Okay. So I have a few names I like. I won't mention them. I DM'd you. And I think you got to run a play there, to me, because on my names, I'm picking, you could have a big gap. The guy was saying, Putin leaves, peace breaks out, which is a chance. But the other flip side of that coin is they peel Germany off, and it's going to be a, absolute energy disaster this fall. So to me, you got readily defined stop losses on your favorite names. My two favorite names are hugging points where I could just get out of them 50 cents, $1, $2. But Oil's turning green every day. My names turn around, they open red, and one of them's up $2 right now. So if we're energy bulls long term, I am. Longer term, there's no way out of this. I think it's a good spot to run some plays. That's just my 2 cents.
I'm totally sympathetic to that, Carpathia. I mean, we're in one of these awkward places right now where, and someone DM me, I think he's right. They said, talk about the energy trade. Maybe you get the bear market in time as opposed to price right now. I.e., we had the crash, we fell out of bed. Some technicians who are more, will say, we need to see more of a base building, whatever. I mean, I could totally see the way you're saying things. I'm also am painfully aware that sometimes the best thing to do is nothing when you're conflicted, and I'm conflicted right now. I see your argument. The flip side of it is, I think the news will continue to go from bad to worse on the economy generally. That earnings are going to be a disaster. That the narrative that the world's falling into recession, I think it is going to gain ascendancy. And we haven't seen a collapse in demand for physical oil. It's been about collapse in demand for financial oil, financial barrels, and that was basically the whole genesis of the stand aside. Or, Michael Belkin's more fundamental. He's like, we're going to recession, demand's going to collapse. Mine was a more nuanced one. I actually said, if you go back and listen to it, which was, I was afraid that the sentiment towards oil would sour as people run with the recession narrative, and the demand, financial demand for oil would collapse, which is what's happened. And so,
Yeah,
right
and
here, right? Yeah, sorry. Go ahead.
no, go ahead. But I tell you what knocked me off the side of the pool. We were sitting on the side of the pool, hand in hand, right, with drinks. Just let's see what
Yep.
happens.
Yep.
Somebody proclaimed they tried to buy oil $5 over the paper price. I can't remember where I saw it, and I started thinking about that the physical, what you just said. So I'm willing to take that chance, but nowhere near the layer that I did in November of 20. But running some plays. It's not going to kill me if it goes the other way, but there's an equal chance. I can shave off. I already have a couple of times, and it's working again today. So I'm just giving my 2 cents. I see
No,
oil down
Carpathia,
too.
Can,
Go ahead.
you and I see eye to eye.
can I jump
The
on
tweet,
this real quick, George?
Go ahead.
hold on, K-Fab, one thing, K-Fab. The tweet you're talking about, I saw that same tweet and I had a similar reaction to you did. I just didn't act on it. K-Fab, over to you.
Yeah, so when I listen to, as I always say, like you, George, I'm a tourist on some of these specific topics. So when I listen to somebody like Dr. Anas say that the physical crude market is relatively well supplied, it's in the finished products where there's issues, the refining capacity. I take note, and then I look at, and maybe Geoff can comment on this. I mean, it looks to me as if the refining stocks have, kind of been a relative weak spot in this downdraft, which to me speaks volumes because the crack spreads are still quite wide. So, and again, within the macro backdrop where I kind of specialize in, if this looks like it's going to be a consumer-driven recession kind of rolling over with the negative impact on real wages, et cetera, and the inflationary environment. And again, if you look at what RBOB did relative to crude, even in this downdraft, it seems to me that this is all kind of setting up for the finished products demand destruction that people have kind of warned about. And if the physical crude market's well supplied and we're on the front end of a global recession, I think that story kind of writes itself.
Really good insight, K-Fab. I mean, it's a confusing situation to put it mildly. And one of the great things.
George.
Yeah,
Just
Jeff.
on KFAB's ideas. I just went in our software. I can very quickly go and look at oil refining. And so if I go and pull up the charts, I'm just going to say long or short. LIN short, MPC short, Valero short, PSX short. The thing is, like our numbers are our numbers. They're data. They're not opinion. And what I'm hearing is a lot of confirmation bias on this. Like, you can find your indicator to look this up, but if you're looking at core strict stuff, and one thing I find really interesting about these energy discussions, there's zero discussion about half of the energy market, which is natural gas, which is clearly in a downtrend and should be like not, because there's such demand for it, and it's a matter of time until, you know, we replace Russia at some point. It's going to take a long time, which is what the price is telling you now. So I don't know. I think that the idea of, oh, I'm setting my stop and I'm okay, I actually think that's not a good trade, because you could wake up one morning and find oil down 20% very easily.
Geoff, let me ask you this. So I think there's a lot of smart guys in this room, and I don't always agree on everything. That's fine. We're just trying to help each other. So I think KFA's point on refining was really interesting.
It's brilliant.
Yeah, hold on. Confirmed by the data. Okay. Could you please share with us? You just mentioned some commentary on natural gas, which, from the cheap seats, if you're flying first class in tourist sector, like the narrative, oh, that should be great for all the reasons you just set out. But can you just share with us, what does the data say on the natural gas stocks, please?
Okay. So remember, like, the way I look at the world is, I first want to know what the bias is. So I go to weekly or monthly, and because of who my clients are, I'm more people that are like David Tepper than are like Warren Buffett. Okay. So I'm gonna always employ a weekly bias to how I look at underlying commodities, and it's still negative. And if I go to my triggers, ETS confirmation, which is one of 4 like price triggers I follow, it had been positive. It peaked earlier in the spring, and now that's negative. My EC spread is negative. So, like, there's just nothing there that gets me excited about wanting to play natural gas right now. It's a nothing burger.
Got it. Okay, let's go to Kevin. Kevin, you've had your hand up. Please unmute yourself, Kevin.
Hi, George. Great space as always. My question, something that Geoff touched on there with respect to the pain trade likely being up here. I'm kind of fascinated by the idea, because I don't do a lot of work on seasonality. And I'm curious, when you see a market that's down as much as it is this year, again, you've got managers that are going to try to protect wins, and you've got managers that are trying to chase performance going into year end. I'm just wondering, has anybody done any work on seasonality specifically in markets like this? In other words, is it actually the flip side, where instead of going into a seasonally weak period, we're actually about to go into a seasonally strong period, given that the market is extremely short, or so it would seem to be, right? I'll leave that out there.
Oh yeah, so I can answer that really. It's really kind of cool. So our seasonality charts go back to 2007 right now. So I'm looking at SPY right now, and I can very quickly click on 2008. I can see how we perform for that whole year against the seasonality right now, and actually it looks a lot like this. George, I'll send this to you afterwards. It's scary. It's like it was straight down in 2008 from May until July. Then we kind of rallied into August, kind of went sideways, and then we hit September, and see you later, fell apart for the rest of the year. So that, and then if I go to, let's see, the next bad period was 2011. Same deal. Although it ended in like late October, beginning of November, and then we just went kind of sideways. I'm looking at the bad years. 2015 fall apart August, September, October, and I think it's, if people weren't on at the beginning, we talked about the seasonality of tax selling, and then the next and final one bucked the trend. It actually went up July, August, September into October, and then it was like one of the worst fourth quarters ever. That was 2018. So 2018 is the only year that kind of bucked the trend.
Interesting. Okay.
Yeah, Geoff, real quick, what was interesting about the 2008 year is, because I think that peak to trough from July and August was over 10%. And again, people have to remember that was in the midst of crude oil blowing up down on the downside, and Freddie and Fannie going bankrupt, right? So that was all unfolding as the market was going up. during that period. So I've called it the fog of cycles. Like once this starts to unwind, you get all kinds of crazy shit that goes on that's inexplicable in the short term relative to the context of the cycle time frame.
Yeah.
100% KFAB, and there's always the need to try to put a narrative with price. And there's so many disparate investor groups out there with different objectives. Like it's not knowable. It's just not knowable. Period. On the post game show, we're looking at the video at the instant replay. Yeah, we can say, well, whatever. But a priori, it's virtually impossible to anticipate. So excellent insight, KFAB. All right, let's go to Rich, and then Rich. Hold on a second here. Rich, you're up.
Yeah.
Hey, George, just one quick thing that people need to be aware of that we haven't talked about related to this thing at all, and it may spur more questions, is everyone needs to remember, and just really every day you come into the office, write it down somewhere and you look at it. You are trading against the machines, okay? And this morning is a great example. We gapped up. We stayed in the 5-minute range until 10 o'clock. Then we ripped above resistance, never came back to it, never looked back at it again, hit the 1 hour high, sat there for a little bit, and now we're just off in la la land. And there is nothing else. The machines will probably just continue to take it higher. But understand, if you don't know what the levels are on a day-to-day basis, like yesterday was a great example on the opposite side where it just completely fell apart. And as soon as we started breaking levels, it was one right after the other. And it wasn't individuals, it was machines doing it. So just understand that.
Thanks for that, Geoff. All right, let's go to Rich, and then we'll do bow tie. Rich, you're up.
Yes. Right now, I think we're at a really important timing situation with these major earnings coming up. And I think we're already in a recession. There's no doubt about it. Some of these indicators are so backwards, it's ridiculous. I mean, I'm in wholesale retail. And a year ago, 15 months ago, inflation was clearly evident. Clearly from what I do for a living. And, price increases didn't even matter. And with the supply chain and all that stuff. So, these companies got to be feeling it. Major companies, Amazon, Apple, whatever, all the major reportings that are coming out. I think finally they are going to be showing it and saying it. And I think it's going to continue for the next 2 quarters. And I'm just wondering if you have any particular favorite put option situations, best shorts in this major earnings season coming up and for the next 6 months.
So thanks for the question. I'll go first, and then Geoff can have a shot at it. I usually don't like to get in the business of picking particular stocks, making picks. I like to help people figure out a way to formulate their own view of the world. I remain very negative on consumer stocks. They've been having a little bit of a bounce lately. I suspect it's the opposite side of the energy trade. The knee-jerk response is, oh, energy down, that's good for the consumer. Oh, gee, the Fed will stop raising rates, blah, blah, blah. But Cantro, he's got to come up here. He's got to do his thing. I love when Cantro talks bearish. Because Cantro will explain, we're just entering the earnings recession. And actually, you know what, Cantro, I actually do a pretty good imitation. I'm going to try to, next room, I got to prepare for this, but I'm going to try to pretend I'm you. I got to change my avatar. I'm not as good looking as you are. At any rate, so I wouldn't get anywhere. I'd be as far away from consumer stocks as possible. Short run, anything's possible. And no, I couldn't agree with you more. So the lazy way to do it, just look at the XRT, which is an equally weighted. There's almost equally weighted. One-stop shopping, for all your unnecessary purchases. A whole bunch of retail stocks. I don't want to get into picks. I mean, yeah, we can, everyone wants to short Costco. I think it's a crappy short because it's defensive and it's got relative growth and blah, blah, blah. And there are a lot of leverage consumer discretionary names tied to consumer durables, which do look like pieces of crap. So it's a very heterogeneous sector. Geoff, do you want to talk just a little bit about the consumer names and retail? Like, what do you see in the subgroups and what looks good, what looks bad? You mentioned before, I think you said like apparel was kind of in the middle. That was okay. But what looks worse to you? What looks better to you within consumer discretionary, Geoff?
Yeah. So if we start with, and I'm just going down to our sector stuff. Okay, so if I go down to retail and see what looks good or what looks bad, first of all, it's near the low end of our work. Automotive retail looks good, in general merchandise, and that's it basically. And then neutral, specialty stores, computer, electronic hardware, and then avoid home improvement, catalog retail, internet retail, apparel retail, distributors, home furnishing retail, department stores. Absolutely at the bottom of the work. I do like AZO and ORLY. Those are both short squeezes in our work. God knows why people are shorting that, but they look bad. And then if I go more, George, you there? I just missed you for a second.
Yeah, I'm here. We can hear you, Jeff. Go ahead. Yep.
Oh, okay. So if I go, first of all, let's go consumer service. Buys, education services, outright buy, and restaurants looking good. To me, the restaurant trade's a no-brainer because if gas prices go down, restaurants do well. If gas prices go up, restaurants struggle. And then everything else is an avoid. Specialized consumer services, hotel, cruise lines, casinos, and I would stay away from any casino that's like Asia-driven because they're being shut down or they're opened up and they struggle off of that. And then leisure facilities as well. One of my favorite shorts is it's like a double play. It's like high discretionary spending, Vail Resorts, and it's also real estate. So this thing could get buried.
We have a winner. So speak to me about the short intensity in the chart, Jeff. What does it look like on Vail?
It's 32. No one's shorted. 32% in 2.39 days. And the tech rank had been at like 10 and 20. It's now up to 50 a little bit. It got a little bit of a put squeeze right now, but this thing looks horrible. It really does.
By the way, last thing we're going to do Bowtie and then Cantro. Speaking of auto parts, so a couple weeks ago, hey Jeff, question: Have you ever I don't know how handy you are, but have you ever like recharged the air conditioning system on your car yourself?
Hell no.
Oh,
I don't do that.
Oh.
I suck at that stuff, George.
I know. So do I. So what happened was a few weeks ago, like my air conditioning was fine, except when you came to a stop and the engine wasn't revving that fast, it kind of like got a little warmer. So I didn't like that. So I called the dealership. It was like, mañana, we can't see. It was just in front of a July 4th weekend, blah, blah, blah. Plus they're going to charge me God knows how much. What, $180 an hour for the mechanic to figure out what's wrong. I'm like, no, that's not going to happen. So I go to AutoZone, and I'd never done this to myself before. And I bought one of these cans of refrigerants, like $49, $49.95. Comes with a meter on top of it. And there's the input and the output. You just got to make sure. Carpathia, why do I think you've done this before? So it's like, I'm like, all right. So the guy, because I didn't trust myself, I popped the hood up and I had the car open the hood up outside in front of the store in the strip mall parking lot. I was like, dude, you got to come out here and show me where to hook this thing up. Because I was convinced, there's differential pressures, the input and the output. And I was convinced, he kept saying, be sure you put it on the input side, not the output side. Because, like, I had visions of me being on the 11 o'clock news, the thing blowing up and blah, blah, blah. And so the guy comes out, he shows me how to hook it up. And, $49.95, and I still got half the can left. We're good to go. So, Jeff, if you need any help with the air conditioning system, just give me a call. I can walk you through it.
Nice. That's so you know what the one anomaly, maybe it's the anti-canary in the coal mine. It's ranked the top group in consumer durable and apparel.
What's that?
It's unbelievable. Home builders are number 7.
Could that be because it was so bad? I mean, it got destroyed before anything else did, and now it's starting to recover from that. Like, why is that?
I don't know. I mean, I just saw that. I was like, wow.
Interesting. All right. Well, Cantro's in the hole. He's on deck. We're gonna do Rich, and then we're gonna do where do we go? We're gonna do Bowtie and then Cantro. So Bowtie up, Cantro on deck, and then Gino in the hole. Bowtie, you're up. What's up? Bowtie?
Hey George, thanks for having me back on.
Hey. Go for it.
So this is a bit of a layered question. So just give me a minute to get it all out here. So as we all know, the DXY is strengthening, like compared to relative to global currencies. The American dollar is the strongest it's been in 20 odd years, right? So traditionally, this is really good for importers. But at a time when we're already dealing with the beginnings of the bullwhip effect, like a lot of these retailers have already overcharged. You're seeing Target, you're seeing Walmart start to do item list returns. Like you'll just bring the item back to the store, they'll give you the money, and you can keep the item as well. Do you see this dollar strength adding to the recession on the retail front? Because we already have an influx of cheap goods, and these imports are going to just keep getting cheaper. Like, any thoughts on, I guess, how that would affect the retail sector as a whole?
Well, the strong dollar, all things being equal, is always a positive for retail, because what you're rightly pointing out. I mean, improves purchasing power. Imported goods become cheaper. We have right now a big inventory problem with retail, as you were giving a good anecdotal example of. You've got what's known as the bullwhip effect, where it's not only is end demand cooling off, but inventories, which previously had been very low, are now very high. And a lot of distributors and wholesalers and retailers find themselves with excess inventory. So I don't know. I think a combination of excess inventory, along with the fact that consumer incomes are now being squeezed, it just still leads me back to the idea I don't want to be in consumer discretionary stocks. I mean, so the strong dollar in the overall scheme of things, to me, yeah, it's all things being equal, which I never are as a positive, but I think it's small beer compared to the bigger constellation of variables that I just alluded to. I hope that answers your question.
100%. Sorry, do you mind if I just add one more?
Yeah, go for it. Yep, go for it. Yep.
That? One thing, because are retailers just going to be giving away items at this point? Because it's going to be good for the American consumer, no doubt. But like, if they're trying to go for a FIFO method, would they try to get rid of their costly inventory now in the hopes that with the strong dollar they can import cheaper ones going forward, so then they can, once prices begin to stabilize?
Having been a retail analyst myself once upon a time, I don't think the strong dollar really figures into the discounting decision of the retailers. They're just, we've seen all the tweets, and Cantro has all the data. I forget the numbers. Walmart and Target and this one and that one. It's like 44 billion and whatever. There's a chart of inventories x autos, and it's like through the freaking roof. And whether the dollar's a few percent higher, a few percent lower, it really is kind of irrelevant. I mean, they've got too much stuff, and they're going to have to move the merchandise. So yes, I appreciate your observation about the dollar. I just don't think it's really the main event in this discussion. And that gives a perfect segue to Cantro. Michael, good to see you. Maybe you want to pile on that or answer something else? What's going on, Cantro?
Hey, George. I just joined. You can hear me okay?
We're good. Yep.
Okay, great. I just joined, so I just caught the tail end of what Geoff was talking about with bear market rallies. So I just thought I'd join and listen in and share my 2 cents if anyone has any questions or.
Kendrick, you just flesh out a little bit more. I mean, I don't know. Did I do a reasonable job of imitating you, or do you got something? Would you say it differently on the consumer side?
No. Yeah, we're kind of seeing the typical. Over the last 3 months, there's been a very big rotation in markets. I just tweeted it showing factor performance. A lot of people look at markets, a lot of people look at indices, and you got to be careful when you look at indices because they're cap weighted, they're sector biased, and so the S&P doesn't really ever tell you anything, or the consumer discretionary sector doesn't tell you everything, right? Amazon's a huge chunk of that. So, the best information for kind of reading the message of the market, I think, is looking at factor performance from a sector neutral perspective. And I just tweeted, I wonder if I can do this. I just learned 3 Aces taught me how to put up something in the tweet here. Let me see if I can do this in the next.
Hey, Cantor, if you get the tweets there, I can throw it up there if you want me to do it while you're talking.
I just did it. Look at that.
Awesome. All right, go for it.
Is it there? So, do you see it up there? Is factor performance?
No, it's not there. Which tweet is it, Cantor? I'll find it. Which tweet is the one you want me to put up there?
I just tweeted it 6 minutes ago.
Okay, all right, you keep talking. I'll tweet it. Go on.
Yeah. So in the last 3 months, we've seen a huge rotation, really starting when commodities started to peak out, and really across the board. You've just seen basically everything that got crushed from higher interest rates, and growth stocks, whether they were high quality or low quality, got thrown out, baby with the bathwater during the first 4 months of the year. And now we've seen a very big bounce. Some of the garbage has bounced, as anytime a problem presumably starts to go away, you're going to get a junk rally. But it's really the quality stuff that has also bounced, and I think is going to continue to outperform here. And this just, I think, is a real clear way to see the rotation back, away from inflation fears and towards recession fears. Everything that's gotten crushed is high beta, high volatility, stocks that are correlated to 10-year yields, high leverage, high earnings variance. I mean, these are all things you want to stay the hell away from, and factors that are really not going to benefit from peak inflation. That's why growth is outperforming. I think it's going to continue to, at least until we really see a problem in the employment market. So, I know a lot of people on these spaces tend to be very short-term focused, and I am not day-to-day focused, week-to-week focused. I'm definitely more big picture. And so a lot of what you guys discuss, and I don't mean this in a derogatory way, is kind of noise to me, and maybe that kind of helps me sleep better at night because I'm not always concerned about the latest tick or trying to figure out the latest tick. And so big picture for me, everything continues to fall in line with our hope cycle, our hope framework, which again is housing, orders, profits, employment. The bomb out number in the NHB index that just tells you that employment claims in a year are going to be skyrocketing. Not that it's going to take a year to start, but it takes about a year for changes in housing to really flow into employment. So we're seeing employment begin to weaken because housing peaked over a year and a half ago, if you look at the NHB index, and that's going to only accelerate. So that to me was a really important read on the cycle. And basically, the market's now digesting the fact that inflation fears are peaking. I think they're going to peak a lot slower or come down. Inflation is going to come down a lot slower than investors are going to hope for. And I don't think the Fed's going to stop hiking anytime soon. Maybe they taper it off. But ultimately, what I think was going to stop them is going to be employment. By the time we get to the fourth quarter, I think claims are going to be above 300, and that's going to really wake up a lot of investors. And so, yeah, we're in the fourth market relief rally here, bear market rally since the beginning of this. If the markets are going to rally, man, it better. This is it. This is the time and place, because we don't have a deep recession yet. People are getting laid off left and right. Parts of the economy are still okay. And the biggest problem, which is absolutely inflation, is starting to stabilize. But again, I don't think there's a tremendous amount of upside here, because the Fed, any upside, I think, just gets the Fed more hawkish, number one. Number two, there's tremendous downside in economic activity and earnings and employment down the road that's only going to continue to grind lower and lower and lower. And so, for now, we've continued to recommend investors who are either long short or long only favor areas of the market that have stable, profitable growth. So, George, you actually mentioned two of my favorite names, and I know you don't want to talk about names, but Costco and AutoZone for us are kind of double. They kind of check the boxes on two things, and Costco's at a new relative high to the market. Again, it's all in the context of relative performance, as is AutoZone. They're both stocks that are stable, profitable companies, and more importantly, they have a counter-cyclical profile. And there's a tweet somewhere in my feed that you can see Costco's relative performance is absurdly macro-driven. I mean, it's almost like clockwork. If you were an analyst covering that stock and you're trying to figure out if it's going to beat the market or not, almost all you got to know is the ISM. And I don't want to take away from the fundamental analysts, but some stocks have more macro influence than others, and that's one of them. So sure, it's expensive, but its fundamentals are stable, and ultimately stability matters a hell of a lot more than valuation when you're heading into a downturn. Not when the economy's good and rates are skyrocketing, which was where we started the year, but where we are today, when the economy is now starting to slowly fall apart or rapidly fall apart, depending on which sector you're looking at, and interest rates are, at least at the long end, and inflation is really starting to peak out and stabilize.
Cantro, Cantro, can't thank you enough for that. I mean, you've just been so on the money, and I'm not paid to say this. And Cantro, by the way, I do want to become a real client, because we're starting up a fund soon. But for my money, I mean, Michael Kantrowitz, I only known him 6 months now. He's the best strategist on the street. Period.
Absolutely. Can I ask Cantro a question real quick?
Go for it.
How would you respond to the inflation being cyclical and secular in the context of everything you just said?
Sure. Well, I think the cyclical portion of it is going to eventually come down, though again slower than I think we're going to hope for. Headline inflation will come down faster than core inflation because of the composition of inflation. Um, Core inflation's, I like to call it the caboose of economic data. If you see on my HOPE framework, it's the last one, and largely because owner equivalent rent or shelter is such a big part of it. And that's not really going to start to decline until a year from now. It lags so much. It lags home prices, lags the economy, and that's ultimately why core inflation is so lagging. And obviously, employment has to really weaken to get core inflation down as well. So, I don't know if, the secular story, we'll see. There's a lot of major global transitions taking place. You're getting companies to onshore the US for the last decade as China is no longer a place where people want to manufacture their goods. If you buy it here, you make it here is kind of the quote. And I'd say actually one of the conclusions is that I think we're going to see central banks or policymakers try to keep their currency stronger for longer. We went through a period from the from let's call it 2000, where the world was booming, and then throughout post the global financial crisis, especially post the global great financial crisis, global financial crisis, where we had deflation and slow growth. So everyone was racing to have the weakest currency because it was kind of free to have a weak currency. You didn't import much inflation, and you exported more goods to your neighbors. In this type of world, if we are indeed at a different point in inflation, it's secularly going to be a little stickier, higher. I think you're going to want to see countries that, or you're going to see policymakers that want to maintain a stronger currency. Something the U.S. administration hasn't really talked about since probably the Clinton administration in the late 90s. And so because that will help stave off some of the import inflation at a time where that's, I think, potentially a bigger problem than trying to export to your trading partners. So I think that's kind of one of the conclusions. So to me, cyclical always trumps secular trends any day of the week. And so even if inflation is going to stay stickier for the next 10 years, there's still always going to be a cyclical component to it. Like even Japan, like if you look in the, they had a lost decade, their stock market went straight down, but they still had a business cycle. And when the cycle improved, their stocks went up. And so there's always a business cycle. So you never want to be married to secular trends eternally because sometimes they'll go against you depending on the cyclical backdrop.
Awesome, Cantro. Absolutely.
Hey,
awesome.
George, I got a question. I got a question for Michael. So this war is going to end at some point, and then we're going to get the biggest rebuild, i.e., a Marshall Plan, that we've ever had since World War II, driven by the U.S. I mean, the country has completely destroyed Ukraine. That's going to spur a lot of economic activity and should be a big positive for Europe, which has been stagnant. Have you thought about that at all in the mix of kind of moving well down the road? I mean, we'll start to see it in our work when that type of companies, when those type of companies start to improve, which are really struggling now. Capital goods stuff is definitely a struggle in our work. Just curious if you've thought about this idea at all.
Not really yet. And again, we're more cycle focused than kind of longer term focused, but I agree with you. That's, there's a lot of infrastructure investment hopefully ahead of us everywhere. Not right now, of course, because of inflation or in Europe because of the war. And I think, when you get cyclicality, a recovery in Europe at some point next year, late in the year, maybe as late as 2024, early 2024, depending on, again, how things play out. Part of the story is always path dependent, but I don't see Europe turning around like PMIs in Europe or really much in Europe turning around anytime soon for the next 12, 18 months. But after that, when, if that kind of lines up with some of the timing of when this war ends, if and when it does, hopefully it does sooner than later. That could create one hell of a booming initial expansion. You kind of, when you put those two things together, we saw that in the early 90s, where the European reunification boom that took place. And so part of, that's why part of Europe was outperforming US markets for much of the 90s, at least early 90s.
So,
sorry, go ahead, Geoff. Go ahead.
So it's kind of a follow on to that is, so if the Fed has made mistakes, I don't know what you want to call what the ECB has made.
Oh, geez.
And so do you actually buy that there's a likelihood they're going to raise on Thursday by 50 basis points?
I mean, remember, this is a central bank that raised twice in 2008. I think it was twice. I think once or at least maybe twice in 2011. Different heads of that central bank than today. So, geez, maybe third time's a charm. They've been known to raise rates when they should probably be cutting rates. So I think they're certainly not going to be easing anytime soon. But Europe only has one mandate. Most central banks don't have a dual mandate like the Fed. European central bank's mandate is really only price stability.
Okay.
Yeah.
So
that's terrific, Cancho. Great. Thanks for the question, Joe. Let's move along here. I want to go to let's see. Rich, did you ask? I'm losing my mind here. Rich, did you ask your question?
I think it's Gino, George.
Yeah, Gino, you're up, and then we'll go to three aces. Gino, unmute yourself, please. Gino?
Hey, can everyone hear me?
Yep, we got you.
All right. Thank you, George, for having me on and for hosting these spaces. My question's geared towards Geoff. So I'm an independent retail trader, and I do a lot of work just looking at commitment of trader reports. Through the lens of these reports, I'm noticing that this market has become a real battleground between commercial traders and large speculators. Right now, from what I'm seeing, at least, the data is setting up very similarly to mid-March before we rallied about 500 points. This time around, it's the vast amount of large speculators piling into shorts while commercial traders take the other side of their bets. To put their positioning into perspective, large speculators haven't been this net short since April of 2020, and commercials haven't been this net long since December of 2011. My interpretation has basically been that commercials are looking to trap large speculators in choppy price action and or a short squeeze until they capitulate out of their shorts. Only then do I feel we will see the next leg down. With that, I raise my question. Do these reports hold any weight in your research? And if so, what are you taking away from them? Thank you.
Yeah. So first of all, we don't chart and we don't plot and we don't look at commitment of traders. We look at, short interest to let us see where people are making bets for or against stocks. And we do the same thing with put activity. I would say a huge difference between now and March is that when the rally started in March on the 14th, there was excessive put activity. That doesn't exist now. And I think you're kind of inferring, tell me if I'm wrong on this. Are you inferring that the small trader is going to trap the big trader?
No, what he's saying. What he's saying, Geoff, is because I know the data he's looking at comes from like Sentiment Trader, and he just looks at like large speculators and commercials and whatever, and it's a dumb money, smart money thing, which I think you've seen before. And the dumb money, which is a little guy, and I just want to make sure I'm pretty sure I'm accurately portraying what he's saying. The little guy, the dumb money, is the wrong way right now. He's really short. With the smart money, the commercial guys are long. That's what he's getting at.
Oh, okay. So that's what he's getting at.
Yep. So Sentiment Trader they do it differently. One of the studies they look at dumb money versus smart money. They define the commercials as a smart money and the little guy as the dumb money, and they always try to measure how long or short smart money is and dumb money is. And when that spread gets really big one way or the other, you back test. It's got pretty good predictive power. So what he was referencing was in March, where you had the little guys all reacting to the headlines and getting all freaked out and wanting to jump off the window ledge, and the commercial guys are getting long. And now we got the same thing again. So that's what he's talking about, the potential for a big squeeze right here.
Yeah, what's funny? We would disagree with that, and we have a thing we use called the Erlanger commitment of short sellers. So we track how short sellers are doing right now, and the vast majority of them are dumb. They're just getting lucky. I call it dumb luck, haha. But we have, let's see, we have 17 of the sectors being driven by dumb short selling. So that would actually argue it's making the same argument, which is for a higher market, which is what committed, but it's doing it from a different perspective.
No, which is really interesting because two different methodologies coming to the same place.
Yeah. So it would argue for a higher market. So
right.
I mean, what's amazing is short sellers have made so much money, and historically they've done it in stocks that they traditionally just basically get their ass kicked. And the only sectors that they're short right now that they historically have made money are software, diversified financials, materials, utilities, telecom, food staples, retailing, and the best is retailers, by the way. Short sellers are the best in retailers. There are a lot of reasons for that, because probably what it shows is that inventories are probably one of the best fundamental tools that you can use to make money on the short side.
Yeah, so sounds like you're agreeing with validating what Gino was asking.
I am, but just from a different way.
Yeah, which is really interesting. I find that incredibly interesting, which again would just screw everybody up. Walter Deemer, please call your office. The market's going to do the best it can to confound as many people as possible. And again, for those who are interested, we have a real treat in store. Walter's going to be speaking in our space at 11 a.m. on Thursday. He's retired now, worked with Bob Farrell, was at Putnam for a million years. He's in his late 70s, early 80s. And it's just a real pleasure to be able to pick his brains, get wisdom from him. So wouldn't that be special? All the fundamental wise guys like me are saying the market's got to go to zero. Won't do it right here, right now. Squeeze everybody. And Cantor, I think you know this. I don't try to follow the wiggles and jiggles either. I'm interested in the intermediate to longer term. But for everyone who wants to get picks and what's going to the market's going to do this day, to me, it's just a fool's errand. It's a waste of time. So summertime volumes are like anything can happen. And again, Cantor, you spoke about it. We referenced it earlier with John Roque with counter trend rallies. Anything's possible. Ultimately, though, you tell me what the fundamentals are going to do. I'll tell you what the market's going to do. And that's why we love you, Cantor, because you're so good on the fundamentals. With that, let's go to three aces. Aces, my friend, what's up? Right? Are you rested up after? Are you rested up after last night's epic battle?
Oh man, yeah, it's getting a bunch of views. It's pinned up on my home tweet there. So if anybody wants to listen to it, George, let me know if you want me to take that down at any time. I can just delete it.
Yeah, we're going to talk about that later. You and I got to have words. Okay. Go ahead, Aces. Go for it.
I wanted to apologize. I'm coming in late. I got stuck in an unexpected. I had to go to immigration and deal with a little paperwork, so I got stuck in the office there. So I apologize. I came in late. Hi, Cantro. Hi, Garbacz.
Hey,
Garbacz. So, Mike, I'm just curious. Gotten some ugly data here out of this NHB and so on and so forth today. Does this restart the clock for us on hope? Do we go all? Is it like go back to go kind of thing and start over, or do we still stay the course on P? And just for just an administrative question, in the context of housing that you referred to, you're simply talking about manufacturing. You're not talking about home prices and Case-Shiller and stuff. Is that correct?
Yeah, it's the leading indicators of housing or across the hope cycle. It's only the leading indicators we care about. So NHBs and building permits, kind of leading indicators of housing, PMIs for orders. Profits are, basically profit estimates. So that's what they are. And then employment is claims. So it doesn't restart the clock. Think about it like this. If you're leading, if I'm drunk and I'm still drinking beer, man, am I going to feel like shit in 3 hours? Or if I'm stuffed and I'm still eating, I'm going to have a nasty stomach ache. And so these things take time to work their way through the system. So when you start to see the housing data get better, you're basically at the beginning of the recovery. And so all that means to me is that it gives me more comfort or confidence that PMIs are going to keep going down, profits have a long way to go lower, and employment's going to get nasty next year. And so that's kind of the way I think about it. It's not housing's going to be the worst part of the economy. It probably is today. Manufacturing right behind, and profits will follow.
Hey, Cantor, I don't know if you heard it or not, but one of the most amazing spaces we had, Ivy Zellman was in last week, and she blew us out of the water. And for those who care, there's a not only is it my feed, but in YouTube, but also she was separately appeared on CNBC, I think yesterday. And what really struck me, I don't know how much you're up on this, on Cantor, as good as you are and whatever, but I don't know how much you get in the weeds on housing in particular. But one thing that really shocked me, and she's the preeminent housing analyst for good reason. She made the point that and Jackson's in the house, as you saw on stage. Jackson, get back up here. The non-primary demand for housing is accounting for 24% of transactions. Specifically, that's Blackstone's buying houses, the build to rent, Airbnb, et cetera, et cetera. And the importance of that is it's 24%. We've never had that before. Yeah, cycles rhyme; they don't repeat themselves. So we don't have the mortgage-backed securities fiasco. But this secondary supply, when this is acted as an accelerant on the way up, it will act as an accelerant on the way down. And you lie that with the fact that she was pointing to the fact that so much of the data now is available on the net. Redfin, Zillow, all this sort of stuff, so economic actors can act more quickly, so that in specific markets, and she was citing chapter and verse from one market after another, be it Florida, Phoenix, whatever, the cancellation rates are absolutely skyrocketing. It went from like 15% to 35%. I think she did in the last, some places 55%. Anyway, the point of all that was pouring gasoline on your fire. I think you might even be more right than you know, quicker than you know. And that is, I was shocked by when she started to put the pieces together. I never heard this before. That 24% of the transactions are secondary, and that you marry that with the fact that there's so much online data available now. The potential for this thing to unravel really, really quickly just set me back on my back heels. I don't know if you heard that argument before, or if you have any reactions to it.
I've been meaning to listen to that space. I haven't yet, but I have it on my to-do list. I've never actually met her, but I always hear good things. But yeah, total. I've heard the data, the stats on the non-primary buyers, and in a way, this is a bubble, just a different bubble than we had in 2000. Well, really, 1995 to 2005, 2006. That was a lack of credit standards. There were no credit standards back then, and this was more just about stupidly low interest rates, especially in the last few years. So it wasn't about credit; it was just liquidity bubble. Whereas it was a credit. Let's call it a credit standards bubble 20 years ago. So 100%. Right on. But I do look forward to listening to that.
Especially because you've been really a thought leader on your approach, and you've been in the vanguard. You've been right, and housing's been central to your view. I really urge you to go listen to that, because she is. I mean, I've known her for a long time, but man, oh man, what a tour de force that was, and it's a must. It's a must listen. It's a must listen. Aces, do you have another question, Aces?
No, I mean, I think I'm good.
We're good.
We're good. Unfortunately, I get to talk to you and Mike every day, so I appreciate it. Thank you.
Anyone else want to speak? We've been going on 2 hours. We did a 4.5, and just one, sort of like post-mortem, post-game show, Aces. For those of you who weren't in the room, we did a space last night. I usually don't do spaces at night, but I got particularly triggered by some of the misrepresentations that were being made. There's a lot of mistruths, half-truths, out-and-out lies that are thrown around on Twitter. And the problem is there's no regulations. There are no standards. People just throw stuff against the wall. And, I can't remember where the line came from. In a bear market, capital's returned to its rightful owner. So now all the charlatans are being exposed. And I got really upset because yesterday one of them doubled down on his lies. And so we had a room last night. I'll try to keep it more general as opposed to specific, on just the lack of honesty, integrity, in markets, and how this has to stop, and the regulators aren't keeping up with it, and how really it falls on people, each of us, to speak up when they see something. I know I've adopted this persona, and I'm fully aware of what I'm doing, of trying to call out bad actors when I see it, because it's not a game. This is not a game. It's heartbreaking when you read the stories about some individuals losing money in this or that. And yes, I'm not absolving them of any personal responsibility. They have agency in their actions. There's no question about that. But the fact of the matter is, some of these people just should not be saying what they're saying, and it's just bold-faced lying, and it's got to stop. And so, this space with Aces last night, and Aces, how we started at 8. I gave up after like 4 hours. How late did you go?
It went until about 12:30. I spent the balance of the hour just dealing with the rows 100 to 600 on the speaker, on the listeners there. So I think the takeaway is, first of all, if you don't mind, George, just to give folks a little bit of a recap, nobody came to the defense of Raoul Pal. They didn't come to his defense on a ethical level, from sort of a professional responsibility in the words and language that he uses. They didn't come to his defense that he has the first clue as to what he's talking about with regards to the technology. The whole sort of, there, by the way, was almost 1,200 people on there last night. So the whole thing is centered around George's, mission about, being true, and being honest. And Raoul Pal has made many comments, but the one that comes to light the most is he said that Luna was basically risk free. So I went around the room, and I'll do it here again. Mike Cantro, Geoff Garbacz, KFAB, you guys are all in industry. Have you ever in your life used the term in an investment to a client or a friend or anybody and said, this investment is basically risk free? Right? So of course they're going to say no, right? Besides for, treasuries. So now here was the most interesting thing from my perspective. Okay. Now I don't want to trash this guy, Ash Bennington, because he was texting me all night and he's sick, and, I somehow I get the feeling that he's leaning in our direction, but just necessarily can't, I don't know if he's an owner or not in there. So, but I thought the most telling thing was when we said to Ash Bennington, because he came up, who's the guy who did the interview with Real Vision, and we said, have you ever used those words? He said no. So the question is not the words that he used, which is the focus of the ethics and so on. The question is, why did he say that? Right? So then we got into the fact that one of the board members of Luna is one of the founders of Real Vision. And there goes the rabbit hole, and so on and so forth. So that's just a mini little, recap of what was said last night.
And Aces, let me just embellish what you said. Ash Bennington is a good guy. And the fact that I'm willing to benefit that, he's a good guy. The fact that he came in the room to listen, and then he even came up on stage, but he chose not to really talk much. And let's take what he said at face value, that he wasn't feeling well. But think about it. If your boss, and he works for Raoul, let's just make this clear. If your boss was being unfairly maligned, even if you were on your deathbed, you put up a few words. So the fact that he said nothing, he said absolutely nothing, was extremely revealing to me. And also, I have to say, and I posted one or two of them last night, the profane-laced personal attacks that I received as a result of this tell me everything I need to know. It's like when you're hitting that type of a raw nerve with people, where all they can come with is 4-letter words, you're on the right side of things. And so I don't want to regale people with stories from last night, but it was just, someone had to do it. And thank you, Aces, for sponsoring. Really appreciate it. All right, boys
George,
and girls.
I just think, George, I think
Yeah.
it's very clear. We had him up on stage. and he avoided the question. I mean, that's indisputable.
Yep,
Right? So,
100%, 100%, Ace, 100%. All right, listen, guys. 2 hours and 15 minutes. We're done. This coming Thursday, Walter Deemer, 11 a.m. Eastern. This has been a great room, Geoff. I want to thank you, and again for anyone who's interested. Geoff is a wealth of information, he's the leading source in the country on short selling, as well as has a terrific market service. Please contact Geoff at Quantitative Partners. You can find him. He's here. He's on Twitter. Again, Geoff, I want to thank you. It's been most informative, and I hope we come back again before too long. Do it again.
Oh yeah, definitely. Thanks, George. Thanks for having me. It was definitely a good one.
Good one. Hey, thanks everyone. Take care. Bye-bye. Bye.
Bye-bye.